What do YouTube? Today I'm going to be showing you guys the best day trading strategy, supply and demand. Let's get into it. Now, I know what you may be thinking. You've already got the best day trading strategy. You already got the MACDs and RSI crossovers down. First,
Stop the cap. Stop the cap right now.
let me just show you a few examples of why this strategy is so powerful and why big banks and institutions also use this strategy as well. Okay, now we're inside of ThinkOrSwim by TD Ameritrade. If you're not familiar with this platform, it's top tier. Now, if you're a Robinhood user and you're used to seeing a red line chart resembling your portfolio balance, don't worry. It looks a little complex, but once you get the hang of it, very simple. Now, what you're seeing is the Nasdaq 100, and you're seeing a bunch of red and green boxes. Red equals supply, or in other words, where we can expect sellers to step in, and green equals demand, or where we can expect buyers to step in. Now, what you see here, zoom out a little bit. Look what you have here. So when you're drawing supply and demand zones, what you're looking for is areas of consolidation, followed by a move upwards or downwards. And what happens is when you see these moves, it's leaving unfilled orders. Now, believe it or not, the market isn't moved by retail traders. It's moved by big banks and institutions. And this is how big banks are moving the market and trading. So look at this right here. On January 20th, you had this little sideways price action. And by the way, we're on the 4-hour time frame. And supply and demand is found at any time frame. As long as you have an area of consolidation followed by a move upwards or downwards, it counts as supply and demand. And you want to think about it in the sense that the larger the time frame, for example, the monthly or the weekly time frame, will be more powerful than the 5-minute time frame. And so something like the 4-hour time frame is going to have more power than like a 1-hour time frame. You just want to start from the weekly time frame or the monthly time frame and work your way down to intraday to find these supply and demand zones. Now, this would be considered a supply zone. How do you draw them? You draw them from the body of the last green candle to the last high before they move down. So this is where the supply zone stemmed from. And when you have a price drop that rapid and that fast, all the orders up there likely aren't getting filled. So it leaves a zone of supply or sellers that are going to push the market back down when price revisits that zone, or push the price back up in the case of a demand zone. Now look what happened here. January 20th, supply zone formed. Price consolidated here for about 3 trading days. Tried to rally back up. And then on February 1st, look what happened. Rallied right into the supply zone. Sold right back off about another 800 points. And then we started making lower highs from there. Now, this is probably one of the most interesting demand zones I've seen in a while. Look what happened here on February 24th when all the Russia and Ukraine tensions were at their peak and everything was official. The Nasdaq sold off about almost 1,000 points and rallied in this demand zone that formed in May of last year. Now, if you were waking up this day, you might have saw the the S&P, the SPY, the Nasdaq, QQQ down 2.5%, whatever it was, and then you saw the Nasdaq also rally 900 points intraday for one of the biggest, or it is the biggest swing in the history of the Nasdaq. If you weren't aware of this demand zone down here, that also coincided with the May low, you might have been trying to go short down here, and you might have gotten squeezed out of your position, not knowing we're coming to a huge area of demand in the overnight session. Now look what happened. Look at where this stemmed from. Back in May of 2021, we had this sideways action followed by a move up. We rallied about 400 points. So this is how you draw a demand zone. The top of the body, the low of the last red candle before the move up. And look what happened back here in May. We had this nice little rally out, pulled right back into demand, sent the market even higher. All these buy orders that were left down here, they came back in. All the big banks and institutions, all the orders are getting filled right here, and sends the market right back up to new highs. Now look what happened back here in this demand zone. All these retail traders weren't aware of this demand zone. They tried to short the market at the open, and the market bounced, rallied about 1,000 points. Look what happened. It pulled back right into the same demand zone from May and February, and we had a huge rally of about 2,200 points. Now look at this. Look at where price came right back into original supply zone from January. Price bounced out this big demand zone from May, rallied in the supply zone from January, and sold right back off. Now look at this. I'll zoom into a smaller time frame. So right here, on April 11th, market started to pull back out the supply zone. You started forming some new supply right here. Some sideways price action followed by a move down. And look what happened. You had about four great short opportunities in this range right here. Each time the Nasdaq rallied in the supply zone, it pulled back about 300 points. You had one short right here, another short opportunity, another short opportunity, another one, and another opportunity. And look at where this last short opportunity. Now it's in the market down about 1,000 points. And the reason I like this strategy so much is because you're following the people who move the market rather than chasing the market like most retail investors do. So just for a quick example of some risk to reward, how you could trade some setups, we're looking at the Nasdaq 100 still. And we're looking at the QQQ 335 puts that expired on April 22nd. We have the supply zone that formed from the overnight pre-market session. So sold off a little bit, formed some supply right here. There's a few things that happened right here. That would have been a great short position entry. We're making lower highs. Lower high, lower high. And you could also say it's forming a bear flag on the 5-minute. And then we got this big bearish engulfing candle on some decent volume right here at about 7 o'clock. These are all valid entries to take a short position. You go short, you get some QQQ puts at the close of this candle. So like I said, we're looking at the 335 strikes. You get some puts right here at 363 a contract. Because you're aware of supply and demand and the strategy you're following, before entering the position, you have a clear stop loss and take profit. So you entered at 363. The stop loss is above the high of this candle right here, and that would be about 184 on the contract. So you're risking about $1.80 on the contract. If you take 3 contracts, you're risking about $540 on this position. That might sound tough, but look at where your reward is. You're risking all the way up to this high to make this in reward potentially. So on this big green candle, you might have got spooked out normally if you didn't have any supply and demand or didn't have a plan before. But because you have a clear plan before entering this trade, you know you're going to stop out above this high of day. It didn't test it yet. Just a little bit of a buying candle, but the market continued to sell right back off. Now you held this trade, you didn't panic out, you didn't let emotions get the best of you. Look what happened. You entered at 363, and the contracts ran all the way up to 764 when they finally ran into demand down here. So let's just say you scale up 2 contracts right here. You finally took profits on 2. That's 110% return in just under 3 hours. So let's just say you have one more contract running. This contract you got for 363, you were risking $1.80 in the contract. They ran all the way up to 1042 at the close. And you would have made about 190% return if you held those all the way into close. Just by risking $1.80 in the contract, you made over $7 on the contract. Now that's a pretty great risk to reward if you ask me. This is why it's so important to have a clear plan before entering each trade. You need to have a clear stop loss and a clear take profit. Using supply and demand, both of these areas are provided for you, and you're following the big banks who are moving the market rather than chasing the market. Alright, now if you guys enjoyed this video, just drop a like and comment. Have any suggestions for me, just let me know in the comments below. Thanks for watching.